Hi, welcome back to John Smith Oro 2. And if you are someone who pays attention to commodities, to precious metals, or just to where the world is quietly shifting its financial weight, then today's video is going to matter to you. Because something happened in 2026 that a lot of mainstream financial media completely glossed over. The United States Geological Survey, which is the official government body that tracks America's mineral stockpiles and resource reserves, released its latest data, and buried inside that report was a number that stopped a lot of serious analysts cold. The number was zero, not low, not declining, not critically reduced. Zero. The U.S. Strategic Silver Stockpile, which once held hundreds of millions of ounces and served as a national buffer for industrial and defense needs, has now been officially recorded at 0 ounces. And when you combine that with what's been happening to silver prices in mid-2026, and with the institutional and geopolitical forces that are quietly building pressure underneath this market, you get a picture that every everyday investor deserves to understand clearly. So today, we are going to walk through all of it. What the USGS report actually says, why the strategic stockpile matters in the first place, what the current price pullback to around $64 an ounce really tells us about where this market is, and what the larger forces building underneath silver right now could mean for the months and years ahead. This is not about fear or panic. This is about understanding, because when you understand what is actually happening in a market, you make much better decisions than people who are just reacting to noise. Let's start at the very beginning, because the concept of a strategic stockpile is something most people have never thought about. The United States government, going back decades, maintained reserves of critical materials, things like oil, grain, and yes, precious metals, including silver and gold. The idea was straightforward. If a major war broke out, or a supply chain collapsed, or a critical industry suddenly needed massive amounts of a material that could not be sourced quickly, the government would have a buffer. A cushion, a way to keep factories running, defense systems functioning, and the economy stable, while the country found alternative sources. Silver was on that list for a very specific reason. It is not just a shiny metal that people put in coins and jewelry. Silver is one of the most industrially important elements on the periodic table. It has the highest electrical conductivity of any metal. It has unique reflective and antibacterial properties. It is used in electronics, in defense systems, in medical equipment, in solar panels, in satellites, and in dozens of high-tech applications that modern civilization literally cannot function without. So the government understood that silver was a strategic material, not just a store of value, and for a long time the U.S. held enormous quantities of it. At its peak, the U.S. government held over 2 billion ounces of silver. That is a staggering number, 2 billion ounces. For context, total global silver mine production today is around 800 to 900 million ounces per year. So the U.S. once held more than 2 full years of worldwide mine output just sitting in vaults. That reserve was built up over decades, largely through coins and bullion that were accumulated as part of the monetary system before the country fully moved off silver coinage. And then, gradually, over many decades, that reserve was sold off, distributed, used up, and liquidated. The process accelerated in the 1960s and 1970s as the U.S. transitioned away from silver-backed coinage, and then it continued through the 1980s and 1990s as government policy shifted towards selling off strategic commodity stockpiles in the name of fiscal efficiency. By the early 2000s, the U.S. Strategic Silver Reserve was already down to almost nothing. And now, in the 2026 USGS report, the official number is 0. There is no longer any meaningful government silver reserve in the United States. None. And here is why that matters beyond just being a historical footnote. The world we are living in right now, in 2026, has a silver demand profile that is completely different from any previous era. The energy transition, the electrification of transportation, the explosion of AI data centers, and the electronics infrastructure that powers them, advanced military systems, and satellite communications have all created a demand for silver that previous generations simply did not have. The industrial call on silver has never been higher, and the government safety net, the backstop, the buffer that once existed, is gone. Let's break this down a bit further, because understanding the demand side of silver right now is essential context for everything else we're going to talk about. Solar energy is one of the single largest consumers of silver globally. Each solar panel requires a small amount of silver in its photovoltaic cells. And when you multiply a small amount by hundreds of millions of panels being installed every year around the world, you get enormous aggregate demand. Global solar installations have been hitting record levels year after year, and projections suggest that trend continues for the foreseeable future. The silver required for solar alone has become a meaningful fraction of total annual mine supply. Electric vehicles are another massive driver. Modern EVs use significantly more silver than traditional internal combustion engine vehicles, primarily in the electronic control systems, battery management systems, and charging infrastructure. As EV adoption continues to climb globally, the silver demand from that sector keeps growing. Then you have AI and data centers. The build-out of the infrastructure to power artificial intelligence applications, massive server farms, advanced semiconductors, high-speed data transmission equipment, all of this requires silver. It is in the connectors, the circuit boards, the cooling systems. The AI boom that has dominated headlines has a physical materials footprint that most people never think about, and silver is embedded throughout it. Military and defense systems are another category entirely. Modern weapons systems, communication satellites, electronic warfare equipment, drones, guidance systems, they all rely on silver-containing components. And this is where the strategic stockpile question becomes genuinely pointed. If the United States were to face a major conflict or a prolonged supply disruption that cut off access to silver from global markets, there is no domestic buffer left. The military would be competing on the open market alongside solar panel manufacturers, EV makers, and electronics producers for whatever silver was available. Now, I want to shift to what is happening with silver prices right now in mid-2026, because the current environment is an important part of the full picture. After a very strong run that took silver to multi-year highs, the price has pulled back to around $64 an ounce, and if you are watching silver, you might be wondering what is going on. After all the bullish fundamentals we just discussed, why is the price pulling back? This is actually a completely normal part of how commodity markets and precious metals markets function, and understanding it helps you see the bigger picture more clearly. Think about it this way. Markets do not move in straight lines. They never have, and they never will. Even in the most powerful bull markets in history, there are corrections, consolidations, and pullbacks along the way. What drives those pullbacks is usually a combination of profit-taking by investors who bought lower short-term dollar strength, shifts in interest rate expectations, and the simple technical reality that when a market gets overbought, it needs to breathe. In mid-2026, we have seen some of those forces at play. Profit-taking after a strong run, some positioning adjustments in the futures markets, and a bit of macro uncertainty around the pace of interest rate policy. Here is what this means for how to interpret a pullback. A price pullback in the context of strong structural fundamentals is not the same as a fundamental breakdown. When the demand story for silver has not changed, when mine supply is still not growing fast enough to meet industrial needs, when government stockpiles are sitting at zero, and when global geopolitical pressures on supply chains are not going away, a price pullback driven by short-term trading dynamics is a very different thing from a market that is genuinely in trouble. The underlying supply and demand math has not changed because the futures market took a breather. Now, if you are finding this useful, go ahead and hit that like button and subscribe if you have not already. We cover precious metals, markets, and economic trends on this channel in a way that is clear, grounded, and designed to actually help you understand what is going on. It means a lot to us, and it helps more people find this content. Let's talk about something that does not always get the attention it deserves, which is the concept of silver squeezes. And I do not mean this in the social media meme sense. I mean it in the structural, institutional, and geopolitical sense. There are multiple layers of pressure building beneath this market that, if they converge, could create supply dynamics that the current price environment is not fully pricing in. Let me walk through each of them. The first layer is what we can call the industrial demand squeeze. We already covered the fundamentals here, but let me add some texture. Silver is what analysts call a byproduct metal. Roughly 70 to 75% of silver production globally comes as a byproduct of mining for other metals, primarily copper, lead, and zinc. This means that silver mine supply is not independently responsive to silver prices the way that pure silver mining would be. If silver prices go up, you cannot just quickly open new primary silver mines to capture that price. It takes years to permit, develop, and bring a mine to production, and most silver will continue to come as a byproduct of whatever the copper and zinc markets dictate. This creates a supply inelasticity that makes silver uniquely vulnerable to demand shocks. When demand spikes faster than supply can respond, the price has to do the adjusting, and right now, demand is growing year after year while supply growth is structurally constrained. The second layer is what we might call the institutional recognition squeeze. For a long time, silver was largely ignored by institutional investors. Pension funds, sovereign wealth funds, large asset managers, they mostly focused on gold when they thought about precious metals. Silver was seen as too volatile, too industrial, too complicated. But that narrative has been quietly shifting. As the structural case for silver has become clearer, and as the energy transition and tech demand have highlighted silver's industrial criticality, more institutional analysts have been revisiting silver as an investment thesis. When large institutional pools of capital start moving into a relatively small market, the price effects can be significant. Silver is a far smaller market than gold in terms of total value, so even modest institutional flows can have outsized impact. Let me also address what some people refer to as the paper silver versus physical silver dynamic, because it is relevant to understanding how the market is structured and what squeeze risk actually looks like. The silver market, like gold and other commodities, has a futures market that operates on exchanges like the COMEX in New York. In the futures market, vast quantities of silver are bought and sold on paper, meaning as contractual obligations rather than physical metal. The total paper silver outstanding is typically many times larger than the physical silver that is actually available for delivery. Under normal conditions, this works fine because most futures contracts are settled in cash and never actually call for physical delivery of metal. But when physical demand spikes, when large buyers actually want real silver rather than paper exposure, the gap between paper positions and physical availability can create what traders call a squeeze. Let's zoom out and think about the big picture here, because I think this is where things get really clarifying. The story of silver in 2026 is essentially a story about the collision of the industrial past and the technological future. Silver was historically a monetary metal, a store of value, something governments and individuals held as financial protection. That role still exists and still has adherents. But layered on top of that traditional story is an entirely new chapter, one driven by the physical needs of 21st century technology. Solar panels, electric vehicles, AI infrastructure, defense electronics, medical devices. This is the new demand base for silver, and it is not going away regardless of what happens to financial sentiment or macroeconomic cycles. Now let's talk about what this means for everyday investors and how to think about all of this. And I want to be really clear here, because I think this matters. I am not going to tell you what to buy or sell. That is not what this channel is about, and frankly, nobody on YouTube should be giving you specific investment advice, because your situation, your goals, your timeline, and your risk tolerance are unique to you. What I can do is help you understand the landscape so that you can have better conversations with financial professionals and make more informed decisions on your own. Here is the basic mental framework for thinking about silver in 2026. Silver is simultaneously an industrial metal and a financial asset. That dual nature means it is influenced by two different sets of forces at the same time. On the industrial side, the demand drivers are structural and multi-year in nature. Solar, EVs, AI infrastructure, and defense spending are not short-term trends. They are decade-long build-outs that will continue to consume silver regardless of what financial markets are doing quarter to quarter. On the financial side, silver is influenced by interest rates, dollar strength, gold prices, investor sentiment, and risk appetite. These forces can move silver prices significantly in the short term, even when the industrial fundamentals are unchanged. The $64 pullback we are seeing in mid-2026 is primarily a financial market phenomenon. It is the interest rate environment, dollar dynamics, and short-term positioning at work. The industrial demand story has not changed. The zero strategic reserve reality has not changed. The supply constraints have not changed. So when you see a pullback, the useful question to ask is whether the fundamental story has changed or whether it is short-term market mechanics at work. That distinction matters a lot for how you interpret price movements and what they mean going forward. There are legitimate risks to acknowledge here as well, because a balanced view requires looking at both sides. The first risk is that technological change could reduce silver consumption in some applications. Researchers have been working on silver reduction technologies in solar panels, for example, finding ways to use less silver per panel while maintaining efficiency. If those technologies advance faster than expected, it could moderate the demand growth trajectory. That is a real consideration. The second risk is that economic slowdown globally could reduce industrial production and, therefore, silver demand. If the global economy hits a rough patch and solar installations slow down or EV sales disappoint, silver demand could come in below current projections. Economic cycles still matter, even for metals with strong structural stories. None of that changes the basic reality that the structural forces we have discussed are real, that the USGS zero stockpile number is official government data, and that the current mid-2026 price environment reflects short-term dynamics rather than a change in the underlying picture. But it is important to hold all of those things in mind at the same time, because markets are complex and outcomes are never guaranteed. Let me bring this back to the big picture one more time, because I think there is a deeper point worth making. The zero in the USGS report is not just a silver story. It is a story about how the United States and the broader Western world has managed its strategic resource posture over the past several decades. The decisions to sell off strategic stockpiles, to rely entirely on global markets for critical materials, to assume that free trade would always be available and always be stable, those decisions made sense in the world of the 1990s and early 2000s. But the world has changed. Supply chains have shown their fragility. Geopolitical relationships have become more complicated. Critical materials have become contested strategic assets rather than freely available commodities. So here is where we land. The 2026 USGS report confirming zero U.S. strategic silver reserves is a genuine data point with real implications. It removes a potential emergency supply source. It highlights the structural vulnerability in America's critical materials posture, And it sits within a broader context of growing industrial demand, constrained mine supply, rising institutional interest, and geopolitical complexity around supply chains. The mid-2026 price pullback to around $64 is a short-term market dynamic driven by financial forces, not a change in the underlying supply and demand picture. And the various squeeze dynamics, industrial, institutional, and geopolitical, represent building pressure beneath the surface of this market that the current price may not fully reflect. None of this is a guarantee of any particular price outcome. Markets are complex, timing is uncertain, and there are real risks on both sides of any investment thesis. But understanding the landscape clearly, knowing why the zero stockpile number matters, understanding what the pullback actually represents, and being aware of the structural forces at work puts you in a much better position to think intelligently about what this market is doing and where it might be going. That is the honest, clear picture of silver in mid-2026. Not hype, not fear, just the facts and what they mean. As always, please do your own research, talk to a qualified financial professional before making any investment decisions, and remember that this content is for educational purposes only. Nothing I have said here is financial advice. If you found this video useful, please give it a like. It genuinely helps other people find this content. And if you are not subscribed yet, hit that subscribe button so you do not miss the next one. We keep it clear, we keep it grounded, and we always try to give you the full picture. I am John Smith. Thank you for watching, and I will see you in the next video.